In this week's video, we'll review the latest charts and data to help us answer the question, is it fair to say stocks in 2025 look just like the bubble in 2000? This chart shows the relative performance of the NASDAQ 100 relative to the S&P 500. It spans from 1990 all the way out to March of the year 2000. Unbelievably, on a weekly closing basis, this ratio closed above an upward sloping 200-week moving average in red for 9 years. This is January of 1991 here. This is the year 2000. Thus, if we're going to compare 2025 to the year 2000, the first thing we should do is understand how crazy it got in the year 2000. From this low here in June of 1998, the relative performance for the NASDAQ 100 looked like it was shot out of a cannon. While there were periods of underperformance walking forward from 1994, the performance was pretty consistent. Thus, for comparison purposes, let's ask and answer some questions. They're at the top of your screen. How much did the NASDAQ 100 gain between October 28, 1994 and March 27th of the year 2000, a period spanning 1,977 calendar days? Second question, how much did the S&P 500 gain over the same period? The NASDAQ 100 from this point down here in 1994, October of 1994, till March of 2000 gained an unbelievable 1,042%. S&P 500 did quite well, 221%, but as you can see, the outperformance of tech stocks in the NASDAQ 100 was significant. In this period, the NASDAQ 100 outgained the S&P 500 by almost fivefold. Now it's logical to ask and answer this question. We know the NASDAQ 100 blew away the performance of the S&P 500 in this window down here. But what about 2025? If we look back the same number of calendar days, roughly 5.5 years, has the NASDAQ 100 outperformed the S&P 500 in the same manner? Does the number look similar to 4.7? Does the slope of the line look similar to this slope here? The answer? The same chart in the present day, right out of the gate, looks significantly different. In fact, since the blow-off top here, the NASDAQ 100 and the S&P 500, for the most part, have been consolidating for a very long period of time. This is the year 2000 here, this is 2020 here, and this is 2025 over here. And relative to the look-back period that we just covered, using the same ratio from 1990 to the year 2000, it's not likely, given the look of this chart, that we're going to see a similar number. In fact, instead of having outperformance that was almost fivefold in the dot-com bust era, we're basically neck and neck, 1.3. If this number were 1.0, their performance would be identical. And as you can see, for the most part, the relative performance of the NASDAQ 100 as compared to the S&P 500 has been in consolidation mode for over 5 years. So the present day chart, numerically and visually, really doesn't look anything, not even remotely close to the end of the dot-com boom and the bust that followed. The 2025 chart on your screen is dated November 14th at roughly 3 p.m. Eastern Time. And you'll notice, unlike the dot-com boom, this ratio was recently below the 200-week moving average for several weeks in here. This is the end of the inflation bear market in 2022. So this is January of 2023. In the first half of the year in 2023, we were still below the 200-week moving average. Contrast that with this 9-year window heading into this blow-off top. This really doesn't look anything like the past 5 years. And we know markets move in fractals, so you can make an argument that this is 20 years of consolidation. This is a bullish breakout. This is a retest and a short stay below an upward sloping 200-week moving average. And now we have healthy consolidation in here for a very long period of time above the 200-week moving average. And we know the longer a market goes sideways, the bigger the move you can expect to get when you either get a bullish breakout or bearish breakdown. And we can't bring our bias into this chart. You have to look at this chart as if this was a 20-minute chart or a 20-day chart in this window. When we say markets operate in fractals, it means if you examine price action on a 1-minute chart, it's very, very difficult, if not impossible, to discern it from a 60-minute chart, a daily chart, a weekly chart, a monthly chart, a quarterly chart, or even an annual chart. How about the final blow-off window in here? This is where it really starts to get near vertical. From this point here in 1998, this is early June of 1998. Look at all the white space between the upward sloping 200-week moving average and the shocking outperformance of the NASDAQ 100 relative to the S&P 500. In fact, in this 658-day calendar window, the NASDAQ 100 outperformed the S&P 500 by almost 8-fold. How does that compare to the present day if we go back and look at the outperformance of the NASDAQ 100 over the last 658 calendar days relative to the S&P 500? Do we have a number that looks anything like 8.0? The answer is we do not. In fact, it's been a very even horse race over the last 658 calendar days. The NASDAQ has only outperformed the S&P 500 by 1.13 times, which is significantly different from what things look like in the year 2000, looking back 658 calendar days. This is what a bubble looks like, and this is what 5+ years of consolidation looks like. Now, how about if we applied this quote to the look of this ratio in early to mid-March of the year 2000? The signals in the market right now say that we're still at the very beginning of the technology. Well, this quote here really doesn't match this look here or this 8-fold increase in this window here relative to the S&P 500. You've heard us say in these weekly videos, the more vertical a chart gets, the less sustainable it is. At some point, what goes up this sharply is going to either stall or go down. But now if we fast forward to 2025 and look at the same quote, the signals in the market right now say that we're still at the very beginning of the technology. Now this is a quote from this week. It's the CEO of AMD, one of the largest chip makers. Now we have to keep in mind this quote, the look of this chart, and really everything that we're covering in the first segment of this video really doesn't tell us anything about what's going to happen over the next 3 trading hours or the next 3 trading days, the next 3 weeks, or even 3 months. The purpose of this exercise is to compare the end of the dot-com boom just prior to the bust to 2025 to help us answer the question on your screen. We believe it's fair to say that the 2 periods look significantly different. Now let's see what we can learn about the present day market and short to intermediate term probabilities based on the charts in front of us. If we look at the weight of the evidence and we try to answer this question, does it still look like a secular trend? And are we still trying to navigate from a point A to a point B that could be several years down the road, understanding that even in the context of the strongest trends, that givebacks are 100% normal and to be expected, and that includes normal givebacks within the context of a secular bull market. Very similar to the conclusions that we drew in last week's video based on the weight of the evidence, we really don't have anything in hand right now that's particularly concerning relative to the S&P 500's trend. These scores are from Friday's session when the S&P was down about 33 points. It finished roughly flat. And like last week, it rallied strongly off the intraday lows. If you didn't watch the stock market during the day today, you may not know that the S&P 500 finished 87 points off today's intraday low, and the NASDAQ finished a whopping 463 points above the intraday low. And all of these scores, they help us assess probabilities, the probability of good things happening relative to the probability of bad things happening. And really what they do is they help us ask and answer this question over and over again. Are we allocated properly based on the charts and data that we have in hand? As of the close on November 14th, the answer is yes. We'll wake up Monday morning, start that process all over again. It's healthy to review drawdowns like this because it can guard against complacency. If you follow the markets closely, you know the Fed has started to back off, and it's successfully reset market expectations relative to a rate cut at the December meeting. It's pulled those probabilities back to about 50-50. So we also have to guard against the possibility that we're getting complacent relative to inflation. A spike in inflation, especially an unexpected spike, could cause a repeat of the 2022 inflation-induced bear market. This is the S&P 500 down here. Thus, with a chart like this, we want to ask two major questions. How concerning is the chart in front of us? And maybe more importantly in this environment, if we get an ugly inflation number or the data starts to trend in the wrong direction, what changes on this chart would be concerning to us? And when we talk about inflation, the market's always concerned about inflation. The question is it overly concerned, or is it a showstopper similar to what happened in early January of 2022? You can see this chart here, XLK relative to XLE. There's a clear shift in here way back in the year 2020 when market participants started to get concerned about inflation. And you'll notice this ratio is falling for over a year before the S&P 500 peaked on January 3rd of 2022. So notice the slope of this line in the ratio 1 year before the S&P 500 peaks. As you can see, we really don't have anything like that in the present day. Since the tariff news became less bad in here in April of this year, this chart has been moving from the lower left to the upper right. That's significantly different from the upper left to the lower right in this window. And tech and growth investors know that in 2022, when the market was concerned about inflation, the tech sector did not perform well. If we look at the chart of XLK in isolation as of the close on November 14th, we can see we're still above an upward sloping 50-day moving average. That's the blue dotted line here. And as far as the anchored volume weighted average price lines, because this chart's in isolation, we have numerous reference points in areas of possible support below price, including the upward sloping 100-day moving average, the dotted green line, and even if we backtracked all the way to the upward sloping 200-day moving average down here, that still wouldn't do a lot of damage to the current uptrend. And this may surprise you if you follow the markets closely. The markets were wildly volatile this week. The S&P 500 finished the week slightly in the green for the 5 trading sessions, and XLK was basically flat. It was down 0.1%. How about the other end of the spectrum? What happens if we should be worried about a traditional deflationary bear market instead of being concerned about inflation? In that environment, bonds tend to do extraordinarily well. This is the peaking process down here for the S&P 500. This is the year 2000. You'll notice intermediate-term treasury bonds started to outperform the S&P 500 significantly. In fact, they turned up here on September 27th of the year 2000. Walking forward from this date, things start to really get ugly in the stock market. So this is the look that we would want to avoid if we were going to go into a traditional deflationary recession and deflationary bear market. Thus, it's logical to ask and answer, how does the exact same chart, the exact same ratio look today? Better, worse, or about the same? The answer is better. The long-term trend is moving from the upper left to the lower right. In fact, this ratio just recently, in October, made a new 52-week low. That really doesn't look anything like the chart from Q1 of the year 2000, where it begins to move from the lower left sharply to the upper right. How about tech relative to the S&P 500? This is the type of look that would be a yellow flag for us. We have the AWOP line, the purple line, tied to the prior low, and the ratio undercuts it here early in January 2022 as the S&P 500 is peaking. That's not a red flag, but a yellow flag in the present day would be to undercut these two thin lines here. And as you can see, there's numerous areas of possible support here, numerous reference points that we have. And notice, these AWOP lines, for the most part, are trending upward. They have positive slopes. And this region down here, after this breakout, represents an area of strong potential support. It's also noteworthy that before the 2022 bear market, we run into a wall of resistance here, and we're consolidating, for the most part, below these dotted lines over here. It's almost the polar opposite over here. We've broken out above these levels. What once acted as resistance has recently been acting as support, and our consolidation in this box, for the most part, is above those same lines. Bad things happened here, and we're still holding a bullish breakout over here. So where we are here, upper right-hand corner of your screen, that would be similar to this look in here in the first half of 2022 when we started to drop below the box. This is a bearish breakdown eventually. This looks like a bullish breakout. This is a chart that we used successfully earlier in the year when the market bottomed, when the tariff news became less bad in here in April of 2025. You can see on the left side of the screen, if we get the anchored volume weighted average price line anchored to this peak in 2022, and then we anchor another anchored volume weighted average price line down here to the October 2022 low, the intersection of those lines acted as support here and again here in April of 2025. A similar look would be the light blue line and the red line. So hypothetically, if we came back and kissed this and this would be similar to come back and kiss this. And from this recent high, hypothetically, if we fell back to this lower blue line, that's a drop of about 11%. And that's not a prediction in any shape, form, or fashion. But we know if we came back here and tested these two areas of potential support and had an 11% drawdown from this window here, some of you are already saying it at home. We all know that's 100% normal and to be expected, even within the context of the strongest secular bull market. Relative to the windows that are similar to where we are today, there were 16 drawdowns walking forward from this point and this point to this peak and this peak. In all 16 cases, the average drawdown was a little bit less than 12%. Why is that relevant? Because when you have a correction in our drawdown within the context of a bull market, the market goes on by definition to print a higher high. And if you don't overtrade your account during the drawdown, eventually your balance hits a higher high. Day by day with an open mind about a wide range of outcomes. Now, eventually we're going to get inflation data on the other side of the government reopening and employment data. We've covered this chart numerous times. This chart of BSV, Vanguard short-term bonds, doesn't look particularly concerned about inflation as of the close on November 14th, 2025. This really doesn't look anything like this indecisive look in calendar year 2021, all of this happened well before the S&P 500 peaked here in January of 2022. Right in here in January of 2022, for the most part, we have a full-bore bearish look. And here, for the most part, we have a full-bore bullish look. If this starts to morph into something more like this, concerns would increase. And that may happen very, very soon. It just hasn't happened yet. You can pause your video player, again, looking at the Treasury market. Market participants do not like to hold Treasury bonds when inflation is skyrocketing, as evidenced by the slope of this line in January of 2022 here. This, in January of 2022, really doesn't look anything like November of 2025. And the look of this chart in mid-November, given what we know today, if the market backtracks, it has a look that says it would most likely be a correction, a normal correction, and that correction would be followed by higher highs, meaning this really doesn't look anything like the rollover process in 2015 or the peaking process over here in 2007 or the ugly look that we had in January of 2008. And this gives you another contrast look here. This is the peaking process when the NASDAQ bubble is popping in the year 2000. Contrast this with this. This looks significantly different and much more constructive relative to this. From a shorter term perspective, I want to emphasize we have a lot of yellow flags out there, including the look of this chart here. So we want to maintain realistic expectations. It would not be shocking if the S&P 500 and the NASDAQ experienced a normal pullback. And we can't be afraid of drawdowns. They're a normal part of doing business in the stock market when you're trying to ride long-term trends. We still have a strong trend as evidenced by the model numbers that we've already covered, but we do have some internal deterioration that tells us that we should be paying closer attention, something that we've been doing now for quite some time. We can show a lot of charts, including this one. It's the ratio of physical commodities. The CRB index is a diversified basket of physical commodities. This ratio compares it to the performance of the S&P 500. Look at the profile of the moving averages over here with the fastest moving average on the bottom with a positive slope in 2021 as inflation concerns pick up well before the S&P 500 peaks. Compare and contrast this profile to this profile. If this starts to morph into something more like this, concerns would increase. We'll continue to take it day by day with an open mind. See how the 20-week moving average is rolling over here in Q1 of 2022? The 20-week moving average just turned up on the same chart in 2025. This has the look of a strong long-term trend. And strong long-term trends can have givebacks. Realistic expectations. You can pause your video player. This is January of 2022. Compare and contrast this profile in this window here to the profile on November 14th of 2025. Compare and contrast the weekly cloud for the NASDAQ 100. Study the similarities and differences between this period, and this period. All this white space in here tells you we don't have white space in here. It's a jumbled up mess. And the fact that green, blue, and red and price are well above the cloud, this is a much stronger trend here relative to this window in here. And that tells us that if we have a 100% normal and to be expected give back, the odds with this profile favor that pullback being followed by a higher high. Those odds are more favorable than the odds in here in January of 2022 when market participants started to get concerned about inflation. Pause your video player. Compare and contrast the end of the dot-com bull market in here. Compare and contrast the profile of this chart as the S&P 500 is rolling over in 2008 with the present day profile with a lot of white space in here. This is a monthly chart a monthly cloud of the NASDAQ 100 dated November 14th. If the upper right-hand corner of your screen starts to look more like this window in here and we undercut the 200-week moving average, as we did in 2022, concerns would increase. Compare and contrast the price and moving average profile in January of 2022 with the present day. This type of time frame would be more valuable over time, but we even had deterioration on this weekly chart of the Dow when the S&P 500 was peaking here in March of the year 2000. And it didn't take long for the deterioration to show up here. In January of 2008, we're into the moving average cluster. We don't have anything like that in the present day. We have a very strong trend look as of the close on November 14th. And we had a very strong trend look in this window here between 2013 and this peak in 2015. And we also had volatility along the way. And we all know, if we're going to use all of this effectively, and if we're going to effectively identify and deal with a bearish rollover look similar to this rollover look and transition from an uptrend to a downtrend that occurred in calendar year 2022 when market participants were concerned about inflation, the only way that we can do it properly is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.